Hello, it's EZG Cards, the master of cardboard risk management, and today's video is going to be a continuation of yesterday's video about the liquidity tax, but today we will talk about when liquidity is your friend and how, as an investor, you can get a premium. Now, when does the liquidity premium occur for sealed booster boxes? It is basically the time frame of 2 weeks before and 2 weeks after a set is released. In this time frame, there are the most buyers of a set. It is the peak hype for a set, and more boxes will be sold in this time period than in any other month. Now, in the last video, we talked about the returns of 2020 to 2023 Magic Draft boxes and the average return after fees, and shipping is around 13.5%, assuming you can sell at market price. So this is the return if you are holding long term. But let's explore what happens if instead of holding these products, you quote unquote dump at release, and why game stores do this, and how their annualized returns dwarf any long-term sealed investments. So first off, let's assume there are about 12 monthly releases for Magic and Pokemon combined, and let's say stores are only making $1 to $5 per booster box after employees, overhead, and shipping, and all other expenses. Or to simplify, stores are making 1 to 5% on their investments. Now, in today's market for Pokemon, the margins are way higher and the same even for Magic, but this is for 2020 to 2023 products, and that was a bear market. But even in bear markets, you can make small margins either by breaking down boxes into singles or selling loose packs in stores. So 1 to 5% is a low estimate. Now you have to remember, because it's the release and there are so many buyers, stores can easily sell out a product if they get low enough margins. So instead of waiting 3 to 5 years, stores get all their capital returned with a small 1 to 10% monthly profit. Now, what are the annualized returns at various margins? Well, at 1%, it's 12.7%, at 2%, it's 26.8%, 3% is 42.6%, 4% is 60.1%, and 5% is 79.6%. So at the lowest end, if stores can have more than a 2% margin, they will always outperform long-term investors, and if they have 3% monthly returns, they will outperform the best long-term investment in Wilds of Eldraine at 42.6% annualized return. Let me repeat. If you can get 3% monthly returns and get all your capital back, your returns will be better than if you invested all your money into the best draft box from 2020 to 2023 in Wilds of Eldraine and held long term. And the Wilds of Eldraine return is assuming you can sell your entire position without the market price deteriorating when demand for Wilds is at all-time lows and will only get lower. So maybe you can realize these returns if you sell fast enough, but some percentage of longer-term investors will always be left holding the bag. If you don't believe me, just compare last month's data of Wilds of Eldraine draft versus Aether Drift playboxes. We are talking about Aether Drift, which is one of the worst sets of all time, versus Wilds of Eldraine, one of the best sets. Now, Aether Drift has 64 boxes sold this month with a market price of $103, so that's roughly $6,650. Wilds of Eldraine market price is $269, with 13 boxes sold this month. That's roughly $3,500 monthly spend. So Aether Drift, which I repeat is a bad set, has almost double the monthly spend or double the liquidity as Wilds of Eldraine. That's how important liquidity is. And when it is in your favor, you can make astronomical annualized gains, and when it's not, you are basically a bag holder. Just go look at Alpha Investments' business model. He has 1 to 3 sales every week, so he is compounding even faster than stores with their monthly releases. Let's say every week he averages out 1% returns. That's 67.8% annualized returns. At 5%, that's 1,164.3%. Just look at the weekly line versus the monthly line. It's crazy. Now, how come Alpha Investment is not paying the liquidity tax when he sells older products? Well, because he is selling these products as an investment, especially a long-term investment. And as we all know, when an investment doubles in price, it is twice as easy to sell. When a normal item price doubles, it is more than twice as difficult to sell. See, on TCG Player, the sales are mostly coming from players, not investors, because there is no sales tax exemption on TCG Player. On eBay, you don't have to pay sales tax if you go through some hoops, so most investors don't want to pay extra and will buy on eBay. Personally, only 1 to 5% of my purchases are on TCG Player because of the sales tax. So on TCG Player, the demand curve will follow normal products, price goes up, demand goes down. So as an average investor who doesn't have a huge patron network, you need to account for liquidity. Your paper gains are not real, especially for older products. On the other hand, any realized gains from selling into the hype is real and also better on an annualized basis. Okay, so like, comment, subscribe for more videos.